With the jump in mortgage interest rates, many reports of rising home inventories are popping up around the internet. Some say we'll see home prices crash soon, while others say prices will stabilize. Nearly none of these reports actually evaluate the circumstances that are needed to forecast price movement in the housing market. Today, we examine the supply of homes for sale in the U.S. and report on the fundamentals that will determine price movement now and in the near future for U.S. homes. Is the supply of homes for sale actually rising? What will home prices do? 5 simple graphs reveal everything we need to know to forecast changes in the supply of homes for sale, as well as accurately forecasting the changes in home prices. The first step in determining whether or not the supply of homes for sale is rising is to evaluate the current supply and demand for homes in the United States. This graph plots the current supply and demand for homes in the U.S. The blue bars measure the number of active home listings on the left vertical axis, while the red line plots the months of supply of homes by using the current sales data and report it on the right vertical axis. Finally, the gray dashed line measures the one-year average of the months of supply. Unfortunately, through the production of this report, we see the trend still falling in the supply of homes relative to the current rate of demand. So reports that have been warning of rising inventories are either wrong or very local to specific markets. Currently, the supply of homes for sale relative to the current rate of demand is still falling. When we look at the far right of the graph, the blue bars show that the current inventory of homes is right at about 1 million homes. Contrast today's supply with the 4 million plus homes in inventory at its highest point back in June of 2007. That means today's supply is 75% lower than what the market observed at its peak and lower than any time going back 23 years. Now, to further investigate signs of inventory growth, let's look at the new construction pipeline to see what's on the way. One quick way to see what the future of new home construction will look like is to examine the number of building permits that have been filed. This graph plots the average number of housing units permitted each month for more than 60 years. The blue bars show the average number of monthly permits filed. The red line plots the 10-year average of monthly permits filed, while the gray line shows the linear trend for the whole period of time. Amazingly, the linear trend has not changed one bit over the past 60 years, meaning we've averaged the same number of permits each month for 60 years. The fluctuations that occur annually are obvious, as too are the 10-year trends. But shouldn't we see a rising linear trend from 1960 through today? After all, the population of the U.S. has nearly doubled from 181 million to 335 million people over that time span. So shouldn't the growth rate of new homes be rising too? The good news from this graph is that our current rate of permitting is the highest we've seen since 2006, and if it continues to climb, we might actually start to see growth in the inventory of homes for sale. Measuring building permits indicates the intention to build homes, but we need to dig deeper to find out how many homes are actually being built, and we do this by measuring a statistic known as housing starts. Housing starts is an economic indicator that reflects the number of privately owned new houses on which construction has been started during a given period of time for single-family houses, townhouses, or small condos, and apartment buildings with 5 or more units. This graph plots the average number of housing starts each month in blue and the 10-year trend of monthly starts in red. Like the last graph, this one shows the linear trend in gray, but it is declining. Simply put, over the past 60 plus years, we've seen a decline in the number of households started in the U.S., even though our population has been growing during those years. This is a great picture of the problem with the U.S. housing market. It is grossly underbuilt for our growing population. One would expect a growing population to show growth in the formation of new households. But the plunge in new home construction starting 15 years ago has brought about a very bad situation where shelter is scarce and both home prices and rents are soaring to very unaffordable levels. One way we can forecast the ability to correct the imbalance between supply and demand is to examine the current cost to build new homes. This graph plots the producer price index of construction materials for the past 22 years. And it very clearly shows a problem that our market cannot overcome anytime soon. The blue bars report the Producer Price Index, or the PPI, for construction materials since 2000. The value of 100 was set in 1982, and all values moving forward have been compared to 1982 prices. The red line reports the year-over-year change in the PPI. From 2000 through 2021, construction costs fluctuated very close to 2.6% annually. When we look back even further, not shown in the graph, but when we look back further, we find that the year-over-year change in the PPI for construction materials averaged 3.6%. But look at what the current market is dealing with today. The PPI for construction materials has averaged a whopping 26.7% year-over-year change since the beginning of 2021. How do we bring affordable homes to the market when construction costs are soaring? The reality is that builders can build homes, but they cannot build them at prices the majority of home buyers can afford. There is a ray of hope that can be seen here, though. Much of the recent soaring costs can be attributed to supply chain issues that began when COVID hit the U.S., and we've seen the rate of growth begin to fall in 2022. Now bear in mind, this is not cost declining, rather it's the rate of growth that is declining. The PPI is still on the rise. The big question here is whether all the soaring costs can be attributed to COVID, or if there are other factors in play. One such cause for rising prices is likely to be found in the numerous jumps in the minimum wage that we're seeing in many states. I believe this is also a factor, and it's not one that we'll find relief from, so we should expect higher building costs due to wage increases for the foreseeable future. I do believe we'll eventually see construction costs stabilize and come down, though I'm not confident we'll see them fall below the level reported prior to COVID. And if I'm right, it will be very difficult to make up for the lack of supply with new construction homes unless we see significant wage growth among most of the middle class in the United States. In many of my videos, I get comments from people who believe that prices are poised to fall solely because they've risen so fast. I always tell them that there is a litmus test that we use to predict these rising prices. Here's how it works. First of all, home prices will not rise until we see a dramatic change in the supply and demand dynamic in housing. If supply remains below demand, home prices will continue to rise. For home prices to fall, we need to see one or more of the following. The demand for homes has to drop so low that the existing supply becomes too much. The demand for homes has to drop while the supply of homes is rising until such a time that the market swings in favor of buyers. The supply of homes has to explode far higher than demand can sustain. That's about it. Any one of these or a combination of them can switch us from a seller's market to a buyer's market. I believe we are seeing the demand for homes drop due to rising mortgage interest rates. But if rates fall, we'll see this trend reverse. The final 2 points require the supply to rise, and it's just not in the cards due to the exorbitant cost of construction materials. On this point, I've had people comment that there are millions of homes in foreclosure that will flood the market. This simply is not true. Default levels in the U.S. have dropped well below pre-COVID figures, and these homes are sitting on equity, meaning they can be sold on an open market, and the homeowners will still get a check at closing despite being behind in their payments. The owners might be facing a hardship, but it's one that can be cured through a sale. I've produced several videos in the past that show foreclosures are not a threat to our market. I deliver facts and analysis, not hype. And by the way, if you're not a subscriber, you probably missed those videos. Please consider subscribing now. This will allow you to get all of our new content when it is fresh. And please mash down on that like button to tell YouTube that this is a video worth watching. Thank you. Another recent comment I've received is that investors are sitting on millions of homes that will soon flood the market. My response? I wish. This too is simply not true. We've seen significant growth from institutional investor activity in the housing market, and they are here to stay. If you want to know more about this, take a look at organizations like Invitation Homes. It's a model that's working, and it's a serious threat to home affordability. They are not buying homes to flip. They are buying for the long-term cash flows that housing provides. The second part of our litmus test for the potential for rising home prices is the study of rental rates in the U.S. It is common for a segment of the housing market to sway back and forth from the for rent market to the for sale market. When the supply of homes for sale goes too high, some homes shift to the for rent market so that the owners do not sit on vacant, unwanted homes. When the opposite is true, homes shift to the for sale market so that the owners can get their full equity and get out of the landlord business. So our litmus test requires us to examine the trend of rental rates to determine the supply and demand dynamic in the for rent market. If rents are falling, the rental market is oversupplied and we can expect to find inventory streaming into the for sale market. The opposite is true too. If rents are soaring, we can expect more investment in the for sale market to turn homes into rental properties. Our final graph in today's report unfortunately shows that there will be no additional supply streaming in from the rental market. Even as home prices are soaring, so too are rental rates. It measures the typical observed market rental rate, something Zillow produces from its immense database each month. It uses a segment of the middle of the rental market to approximate the median rent, and it shows that just like home prices, home rental rates are soaring too. The blue area measures the rental rate index each month, the median rent, while the red line plots the year-over-year percentage change each month. It is this red line that assures us the rental market is no more healthy than is the for sale market. As the inventory of homes for sale has declined, so too has the inventory of homes for rent. How do we know rental inventory is dropping without actually measuring a data set of rental unit supply? We can deduce this because rental rates are soaring. The median rental rate last month was more than 16% higher than the median rental rate of 1 year ago. People who are renting today are facing huge increases when their leases renew, and this means that home affordability for tenants is tanking as quickly as it is for homeowners. This means our litmus test is producing very clear results. There are not enough homes in the U.S. to house our growing population, and something needs to be done very soon. It used to be easy to become a tenant when home affordability declined, but that solution is not working today. With rents rising even faster than home prices, people are going to find more of their disposable income being allocated to shelter. We're seeing a rise in the homeless rate in the U.S., but I believe it's just the tip of the iceberg. The solution to the housing mess will likely be wage inflation. That takes time to kick in. The U.S. is facing a home affordability crisis that's going to require either a reduction in the population or an increase in the number of housing units, or a combination of both. The way to thrive in this environment over the next few years is to acquire real estate if you can. Real estate will beat inflation, and you can leverage it with a mortgage to surpass the rate of return you'll find on most investments and with far lower risks. If you've been thinking about moving, but you're worried you'll sell your home and not be able to find a replacement, then we have a solution for you that has been making people very happy lately. We'll get your home sold with the provision you can stay until you find the replacement home. If you never find the right one, you don't have to move at all. Ask us about our stress-free move. It might just be the answer to your prayers. If you cannot afford a home, try to get into a long-term lease that protects you against the coming rate hikes. For example, get a 5-year lease with a rate that only rises 3% per year. These will be trying times for many American families, and the time to act is now. If you have any questions or comments, leave them in the comments section below. We wish every American the right and ability to afford a home, but we acknowledge that this does and will continue to present a huge challenge for many. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box on the top left corner of your screen. To see a popular video featuring my 6 top home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.